All right, here we are, Death Taxes in this podcast, episode 8. I'm here with my man Joe. How you going this morning?
Very good, mate. It's been a roller coaster.
Yeah.
Roller coaster of a morning in the wet.
We almost didn't get it started, right? Like, yeah. Tiki held you up a bit?
Standard, mate. Standard.
What happened?
Standard morning. Nah, it's just the wet making life harder to get him in daycare, man.
Yeah, fair enough. All right, on the episode today, we're going to go through valuations and how they might impact your small business. So this will be, or like all of our podcasts obviously are done for small businesses because that's what we specialize in. And I assume that, you know, the CEO of ANZ Bank's not listening. So we'll go into valuations and we're going to go through why they're important and how they all work for small businesses. So
yeah, perfect. You want to jump in with why you would need a valuation for your business?
Yeah, okay. So a couple of reasons that you would probably go and get a valuation. Let's start with like the worst one first. So like a lot of like clients when they go through a divorce, for example, they need to, know what the business is worth. So like a lot of families and stuff, the business will be worth more than their house in a lot of circumstances. And, when couples are unfortunately splitting their assets at that point of their lives, you want to know what it's worth and make sure all the financial stuff on that goes through properly. So obviously you need to go get a valuation. All right, now on to the better ones, which we do more of, luckily. Obviously, you would do it if you were going to refinance. So if you were like needing to recapitalize your business and you had to borrow off someone, you want to go and see what it's worth. So like, say for us, for example, we bought an accounting practice in our first year, I think, out or second year, and we went to the bank and we had to go and tell them what the value of our current business was so that they would then lend to us based on the business we were buying plus the other one. So in that circumstance, you'd want to go and get a valuation. The other reason you might want to go get one is, if you're selling, so like you might be selling the whole asset. So like if part of like your continuity planning retirement planning, or otherwise you might be getting investors in.
Like when you're getting these valuations done, like what types of methodologies are we using here? Or does it depend on the business or?
Yeah, okay. So I'll go into that. So there's different valuations, for different reasons, right? So the different methodologies are the income-based, which is like basically, and I'll go into a bit more detail on this later, but like the income-based is like what is the, EBIT or revenue? Like
can you just explain EBIT for people?
Yeah, sorry, earnings before interest and tax, depreciation, amortization for EBITDA. And that's like I like to say that's your cash profit, right? So EBITDA is your cash profit, and that's like sort of Warren Buffett's type like valuation. He loves like sort of cash flow, and the income based valuations for Warren Buffett are like they're the best you can get.
Yeah, so he'll buy when the EBIT's low and then sell when the EBIT's high.
Well,
or the other way,
Or like when the multiple's low. Like so if the EBIT's high and
the multiple's low.
Yeah. So he does like a PE type thing, which is the income-based methodology for valuations. So, I mean, like I like that method the best myself because like if I'm going to put, $1 in and you're going to pay me 10 or 15 cents every year, like it's very easy to value the business and like you're getting like actual creative value. Like, like as in like you put money in, you're getting a return straight away.
Cash in and then you get some cash out and you know when it's going to be repaid, the capital and that kind of thing, So like I worked in M&A and ANZ for a very, very long time. And then I worked further at like AZNJ with you obviously, but like that was an M&A company and that's the sort of valuation they did. So they were like, we're going to pay a multiple on your EBITDA or we'll pay a multiple on your revenue, which I'll go a bit into a bit later. But yeah, so that's the income-based valuation. That's the one that like everyone that loves fundamentals, they love that sort of valuation. And that's like Warren Buffett. So Warren Buffett's very, very famous for going in and doing like probably the best valuations of that and just buying at the right time when he thinks that valuation, the way that's done is very low, he'll buy then and then obviously it gets up to the average or higher and that's when he sells. Okay, so the next one is like the market-based valuation. So this is the one that I don't like, most accountants don't like it, but all your like, IT Silicon Valley guys love it. Like, so I'll give you an example. So like say Amazon and stuff like that in the .com bubble, like they had like no profit and they were selling for like, $100 a share or something stupid, right?
But that's the market value. That's what it's selling for. You know what I mean? And then that's what the market's paying for that particular asset at that particular time. And even like when you look at all the IT companies now and like Silicon Valley and stuff, they're still paying stupid multiples on these stupid things. So that's one, like, it just doesn't make any sense to us, but it doesn't have to. That's what the market's paying.
Nah, and it's easy when it's a listed entity, right? Like there's an open market and everyone knows what the market value is because it's listed every day and it moves in real time. Whereas small businesses, like, it's not an open market. They're not listed. There's nowhere to easily sell it. So, like, you're not going to see that kind of valuation.
It would. Yeah, you're right. It's pretty rare. Like, unless you were like an IT company and one of those idiot big ones came and bought you for an idiot price, which you should definitely sell. So that's like market based. There's no real fundamentals on it. It's just what everyone's paying at the time. People will say like it's based on, like, they try and explain it like it's based on future earnings rather than current ones, which is more like what the income based one is on. Anyways, they're hard to understand, but as you're saying, it rarely happens in this sort of business. So all right, and then the last one, which is like, probably not the best, is like more a cost based one. So we're seeing a couple of these at the moment. Just the economy is going quite poorly, and there's a couple of liquidations that we're seeing. But yeah, on the cost based method, it's sort of like almost like a fire sale price. So like it's like often when companies going through liquidation, you'll get a valuer in and they'll say like, oh, what's this worth, right? And for small businesses, like a lot of the time you are the business. So like if you're not working in the business and it's going into liquidation, it's worth zero. You know what I mean? So that cost-based methodology, it sort of helps people in liquidations when they're restructuring. They can sometimes buy their old business for a really cheap price because if they're not in it, it's not really worth anything. And then they roll it into a new entity and stuff like that. So that's the cost-based methodology, which
you do see often. Like the value of the business ends up being just like what the fixed assets are.
Yeah,
almost.
Correct. Like, no, it literally is. But like if you're going into liquidation, okay, so two ways. One is like business is closing down, right? And they're not going into liquidation. And then it's just like the fixed assets, which I'll go into further because like obviously that's part of how the valuation split up, you know what I mean? And you're talking about equity value, you know what I mean? So yeah, it's like pretty much what the fixed assets are worth. Or if you're going into liquidation, obviously you got negative fixed assets. So like it's worth negative, which means that's why you have to close down.
It's like the football clubs that have huge amount of debts and they end up selling for $1. You got to take on the debt. That's what you start buying it for.
Just so they don't go bankrupt. Yeah. No, exactly.
We'll be looking out for one of those one day. Perfect. Yeah. Do you want to go into what you were talking about there, like equity value and all that kind of stuff?
Yeah, so generally for small businesses, the way that the valuation's done is like they'll split it out into enterprise value and equity value. Enterprise value is what we were talking about before with the income-based amount. So like you've got your EBIT and then you times it by multiples. So like I used to work, as I was saying, at ANZ Bank in the financial planning arm. I did M&A there for a bit before I went on to the M&A company with AZ, right? And they both did like the enterprise value, and then they would add equity value. So the enterprise value they used to do was just, for example, like say 10 times NPAT, which is net profit after tax.
And how are people getting that 10 times or the multiple, like for different industries? Is it industry based? Is it the size of the business? Is it?
Yeah. So I'll go into this first and then I'll go into that. Like, Perfect. But like, agree. We'll go into how the multiples are formed. So like enterprise versus equity value. So enterprise value is obviously that like income base that we're talking about. And then the equity value is exactly what you were saying before, is like what the balance sheet's worth. So you would do like, let's say I've got $1 million worth of EBIT, my multiple is 7. So my enterprise value is $7 million, right? But then say I've also got $1 million cash on my balance sheet. So I got net assets of $1 million. Then you add those two together. So 7 plus 1 equals 8. And that's how you value your business. A lot of the times, like places will grow through acquisitions. So like instead of having a positive cash amount, they might have a negative cash amount on their balance sheet. So you might have, $1 million and then 7's the multiple. So let's say enterprise value is still 7, right? Because that's like pretty easy to understand. And then your balance sheet has like $2 million worth of debt, right? So then it would be 7 minus 2, and then the valuation of the business is 5. So that's pretty much as simple as evaluations work. But yeah, so as you're saying, next question in terms of like, how do you come up with a multiple? Okay, so obviously the market is like the main one that drives the multiple. So like I'll give you two really good examples. So like I've done a lot in accounting and financial planning. Financial planning is like 3 times revenue, or as I was saying, 7 times EBIT or 6.5 times EBIT, depending on who you're talking to, which is 10 times NPAT. The market just drives that. But like the only other thing is like you need to be a certain size to demand that. So like obviously the size of the business is another thing that's going to demand the multiple. So like if you're a smaller business, people are only going to want to buy the revenue because like you're not really a business in their eyes. So like if you're like less than $1 million revenue or less than $2 million revenue, like you are the business, then like you're not really a business. So they're not going to pay you an EBIT multiple because it's not going to give them like the value over time, right? So the size of your business is definitely like another thing that's going to probably derive it, right?
Yeah. Any other areas that change the value?
So like you got your growth rate. So like if you're growing faster, then that's like the Silicon Valley type thing. Like but if you are a small business and you're growing much faster, obviously you can command a higher multiple because like your growth rate's going through the roof. Then there's like recurring revenue, or they like to say like secured revenue. So like how much is your revenue next year going to be the same as this year or better, right? So if I compare like legal firms, like lawyers, I feel so bad for lawyers, man. Like they have to go and get the best UAI and all this sort of stuff, and then in the end of the day, their business is like a shit model. Like
yeah, it's like they're the value, and then if they try to sell to someone else, like the relationship is what they have, right?
Yeah, they can't sell because they don't have recurring revenue, so they're out there like busting their gut every day for these one-off jobs.
I think that's why like the lawyers go to the bigger firms.
Yeah,
because there's more value in the name of the firm, at least the brand, that keeps clients going back to it.
Yeah.
At least so if you change the lawyer, they don't care as much. But when you're using a small person, small business lawyer, and they leave, like, what is it? Nothing.
Yeah. So it's just like, it's a really high paying job. Like there's not, sorry to the lawyers, like you got fooled when you were like 17 and you
have to work 24/7.
Oh mate. Yeah. Like they got duped, mate. Fully duped. Like we just got lucky that we were like into accounting. All right. And then, so then the next one is like obviously margins. So like if you're in like an ultra low, like I say a building like company, like they make, 2 to 10% margins, if anything, like, how many of them have been making losses recently that we've seen. Like those super low margin businesses, like, and then once again, their work's not recurring. So like, they're not really worth like a whole lot. Whereas like, if you've got like a high margin business and you've got recurring revenue, like say like our business is like everyone has to do their tax return every year. We've figured out a way that we can make quite good margins on doing that with good service and stuff. So like, and they've got to come back to us every year. So it's like recurring with really good margins, mate, Mickey Mouse.
Perfect. I've got here cash flows as well.
Oh yeah, so like obviously like the higher dividend yield and stuff, like it's going to be worth more. I mean
that comes from profit at the end of the day.
Yeah, correct. Yeah. That's the Warren Buffett way of thinking about it. How much cash can you get back?
There's some important things to think about.
So some important stuff to think about is like this asset. If you're a small business, is worth more than your house a lot of the time. So when someone's going to come and look at it, like you can't have a leaky roof. You know what I mean? Like if you're trying to sell your house and you want to get top dollar for it, like you're going to go and do a renovation and new paint job and all that sort of stuff. Now, what buyers come in and they want to see is like good, consistent, robust processes. Like, they want to see accounts that are up to date, tax lodgements that are done on time, bookkeeping, reporting. If they want to get an EBIT number, they don't want to go into a spreadsheet and have like all these add backs and stuff. They want to actually see what it looks like in the accounting system. They want to have like, stuff set up so like it all looks good. And like they don't want it all just like thrown together at the last minute because you wanted to sell on that day. You should be doing this every month for 5, 6, 10 years before you sell it. And that's the sort of stuff that you want to be thinking of.
I think as part of that as well is like the internal processes have to be like strong. Yep. It's not just your bottom line. Are there processes from start to finish that have, not relying on one person and all these kind of things. Because at the end of the day, like especially if you're the one who's selling and you're the one who's involved in all the processes, how are they going to take over that business? Like you need to have a process in place where you can extradite yourself out and the business continues on, right? Yep. Otherwise it's very hard to sell.
Yeah, that gives more value. Like if you can go and buy an asset and it keeps giving you cash and pays you back over time, it's worth more than if you buy one and you've got to sit in there yourself. And like Robert Kawasaki, mate, like Rich Dad Poor Dad, he's the guy that says that. He's like, don't go and buy yourself a high paying job He goes, if you're going to spend money, go and buy like a proper business where you don't have to be involved in it. You sit back, and obviously people pay more for those, but there's less work for them over time, and that's what you want to set yourself up for.
Perfect. Thanks, mate.
Thank you.